Imagine a $14 billion financial magnet.
Right.
And it's engineered specifically to pull a global market to exactly $75,000. I mean, every quantitative model is betting on it.
Oh, absolutely. The algorithms are literally hard-coded for it.
Yeah, and market makers have hedged billions expecting it. And then in just a single 24-hour window, someone just unplugs the magnet.
It was a complete microstructural failure. I mean, we're looking at a scenario where mathematical certainty, like the fundamental gravity of the derivatives market, just snapped.
Welcome back to another custom-tailored deep dive. For you listening, we know you already have a firm grasp on the foundational mechanics of digital scarcity, so we're skipping the basics today.
Yeah, we're jumping right into the deep end.
Exactly. Our mission for today's session is to impartially unpack this intense 24-hour reporting window that closed early on March 27, 2026.
And it is a dense 24 hours.
It really is. We are tracking a massive collision here. You've got forced algorithmic liquidations, a multi-billion-dollar options expiration failure, uncontainable kinetic warfare in the Middle East, and a really high-stakes legislative blockade in Washington.
The through line here is fragility. You know, we're going to trace how a targeted strike on a naval facility in Iran fundamentally rewired the order books of U.S. spot ETFs.
Which in turn completely shattered a $272 million algorithmic safety net.
Exactly.
So let's start with the damage report on the ground. Going into the March 26th session, the market basically assumed that $75,000 max pain options threshold was inevitable.
That was the consensus, yeah.
Right. But instead, we got a localized collapse. The measurement window opened at 07.00 CDT, with Bitcoin sitting near $69,245.
Yeah, and it was attempting to hold a very narrow consolidation channel right there. But the moment institutional bid-side liquidity began pulling away, I mean, that 69K support just disintegrated.
It really did.
We tracked a severe downward contraction straight through the 68K and 67K parameters. It bottomed out in an intraday trough near 66,200.
Before finally settling at 66,067.
Right. So that's a 3.72% net contraction.
Yeah.
Which, doesn't sound apocalyptic on its own, but the velocity of that drop, that's what triggered the systemic alarms.
Yeah, the momentum models didn't just register a dip. They went into this hard-coded defensive posture.
Instantly.
We saw indicators like the MACD and the relative strength index flash synchronized sell signals. But, instead of just listing these textbook metrics, let's unpack the mechanism for the listener.
Sure.
When those specific momentum models flash red simultaneously across multiple time frames, what is actually happening inside the institutional trading bots?
Well, it triggers a pre-programmed reflex. I mean, these bots don't feel fear, right? They just execute mathematical mandates.
Right.
So when the FCD histogram flips deeply negative while the RSI drops, quantitative algorithms read that as a terminal loss of short-term momentum.
You just see the math.
Exactly. Their operational parameters force them to immediately de-risk. They systematically dump spot assets into the open market to preserve capital. They sell the exact moment that algorithmic line crosses, completely devoid of human emotion.
And this automated dumping is happening within a very precarious macro geometry on the charts, isn't it?
Oh, highly precarious. The market is effectively trapped right now. Overhead, you have the 0.236 Fibonacci retracement level sitting at 75,719.
Which is acting as apex resistance.
Right. Algorithms are programmed to aggressively sell into that ceiling, and then underneath, the entire structure is relying on the 1.61A macro extension at 62,084. That's the absolute fail-safe floor.
So if that 66,200 intraday low bleeds out further and snaps that 62K floor,
then the mathematical probability of a structural collapse down toward the 42,000 to 45,000 measured move target increases exponentially.
Wow. Which makes the actual liquidation engine that drove this drop so critical to understand. Over this 24-hour window, the derivatives market absorbed a $272 million algorithmic wipeout.
A massive flush.
Yeah, and the asymmetry in those numbers tells a story of extreme leverage. Out of that 272 million, 228 million were long positions.
Yeah, that's a 5.1 long to short imbalance.
Insane. Bitcoin futures ate 108 million of that, and Ethereum followed with almost 74 million.
That 5.1 ratio is the classic signature of a severe liquidity vacuum. Tactical traders had just aggressively over-leveraged their portfolios with long exposure.
Because they were anticipating passive ETF flows would just carry them straight to that $75,000 options magnet, right?
Exactly. It's kind of like a boat where all the passengers rush to one side.
Yeah.
They're all so sure of the destination, they don't realize how top-heavy they've made the vessel. It only takes a tiny wave to capsize it at that point.
That is a great analogy. So Explain the internal mechanics of that capsize. How do routine margin calls turn into a $250 million avalanche? Like, what's the mechanical interaction between the exchange matching engines and the market makers during a drop like this?
Okay, so think of a market maker's limit orders as the structural flooring of the market. When ETF demand failed to materialize, those algorithmic market makers realized the imbalance. And
Oh,
to protect their own capital, they systematically deleted their buy orders from the bid side of the order book.
they just pulled the floor out.
They removed the floor entirely. Consequently, the spot price falls freely into a dense concentration of leveraged stop-loss orders.
And once a long position hits its liquidation threshold, the trader is no longer in control, right?
No, not at all. The exchange's matching engine forcefully takes over. It executes an automated market sell order to close the bankrupt position.
But because the market makers had already withdrawn their bids,
Those automated sell orders have to reach lower and lower into the order book to find a buyer. That violent downward action instantly triggers the next batch of liquidations.
creating a cascading, self-fulfilling spiral.
Exactly. And it only stops once the leverage is entirely purged.
Man, but that cascading spiral doesn't happen in a vacuum. The matching engines only panicked because the institutional spot pipelines suddenly shut off.
The ETF flows.
Right. We saw a highly synchronized capital flight from the U.S. spot ETF complex during the Thursday trading session. It wasn't just one nervous fund manager.
No, it was systemic.
Across the board, from BlackRock to Fidelity to ARK, a net $171 million was extracted in a single session. They all hit the panic button at the exact same millisecond.
The structural selling pressure was just immense. BlackRock's IBIT led the bleed with 41.9 million.
And the Ethereum ETF complex suffered even worse, didn't it?
Yeah, hemorrhaging 189.3 million.
Yeah.
And that was largely driven by BlackRock's Ether product losing over 140 million.
Oh.
To generate the fiat currency required to settle those redemptions, authorized participants are forced to physically liquidate the underlying collateral. They execute algorithmic time-weighted average price sell orders directly into the spot market.
It's dumping it. Before we get to what triggered that synchronized ETF panic, I want to highlight one glaring counter-trend we found in the alternative asset spectrum.
Oh, the Goldman Sachs anomaly.
Yeah. Amidst all this primary network outflow, a Q4 2025 filing revealed that Goldman Sachs emerged as the largest institutional holder of spot XRP ETFs. They're sitting on 152.17 million across 4 funds.
It's a highly notable data point, for sure. I mean, a $3.5 trillion asset manager allocating that scale of client capital indicates a real structural integration of alternative digital assets into traditional portfolios.
Right.
However, as a macro force, that isolated accumulation was just completely overwhelmed by the aggregate outflows from the primary monetary networks.
The macro trend always wins.
Always.
And that macro sell-off directly engineered the biggest mystery of this whole reporting window, which was the historic $14.16 billion Deribit options expiration.
Yeah, this was huge.
Usually the max pain threshold, which was firmly established at $75,000 for this expiry, acts as a gravitational magnet.
Because under standard conditions, institutional market makers delta hedge their positions to neutralize risk.
Right.
If they sell a call option, they buy the underlying asset as it moves closer to the strike price. That hedging activity is what physically pulls the spot price toward the max pain center of gravity.
Okay, push back on standard financial theory here. Wait, if the magnet is at $75,000 and they're mathematically incentivized to pull it there, why did the price plummet to $66,000?
Well, standard theory assumes a relatively stable underlying price. What happened here is a phenomenon known as delta decay.
Delta decay.
Yeah, the spot price dropped so violently from those ETF outflows we talked about that the massive cluster of call options became hopelessly out of the money.
Oh, I see.
Their delta, which is the sensitivity of the options price to the underlying asset, it just rapidly decayed to zero.
So because the options were mathematically dead, the institutional market makers were no longer mathematically required to buy the underlying asset to hedge risk.
Exactly. The hedging requirements just evaporated. The spot market completely decoupled from the max pain magnet and was left to free fall into the 30-minute settlement window. Zero institutional defense.
It's kind of like a localized magnetic field, you know? If a piece of metal is a few inches away, it snaps to the magnet. But if a physical force throws that metal 20 feet across the room...
The magnetic field doesn't just weaken, it mathematically shuts off. That's a perfect way to look at it.
Okay, but looking at the forensic data of that options matrix, I noticed a really strange anomaly on the downside. There was a $596 million cluster of 20K puts.
Ah,
With
yes.
the spot price in the upper 60s, a 20K put is profoundly out of the money. Are institutional funds seriously hedging $500 million against a flash crash to 20K?
Actually, the strategy is the inverse. Sophisticated quantitative funds were actively writing, meaning selling those deeply out-of-the-money puts.
Oh, they were the ones selling them.
Right. They ran the probabilistic models and determined the chance of a structural collapse to 20,000 before expiry was near absolute zero. So they sell the puts to harvest the guaranteed fiat premiums from whatever tail risk funds are irrational enough to buy them.
That's
It
wild.
just demonstrates severe yield starvation in the current environment.
Yeah.
Quants are willing to leverage massive capital just to extract fractional percentage yields.
Okay, let's connect the chain here. The $14 billion options magnet mathematically broke because the ETF buyers suddenly pulled $171 million out of the spot market, which left the derivatives market defenseless, right?
Exactly.
But why did traditional fiduciaries suddenly panic and pull that capital? Quantitative models don't just panic over nothing.
No, they're reacting to physical reality.
Right, they are reacting to the uncontainable kinetic escalation in the Middle East that hit on Thursday.
The transition from market structure to geopolitics, the established boundaries of diplomatic deterrence just failed.
Yeah, the catalyst was the Israel Defense Forces executing deep penetration strikes on apex sovereign targets inside Iran.
Specifically, a critical naval weapons production facility in Yazd.
Right, and this wasn't just a peripheral proxy target. This site was used to supply the blockade of the Strait of Hormuz.
Degrading that specific logistical node transforms the engagement entirely. It signals a direct war of logistical attrition. Quantitative models immediately register that the Islamic Revolutionary Guard Corps, the IRGC, will be forced to respond.
And their retaliation was instant. They launched Wave 83 of Operation True Promise 4.
The target matrix expanded dramatically.
They struck Israeli oil depots in Ashdod, military personnel in Modi'in, and crucially, they targeted forward-deployed U.S. installations.
Yes, the Al Dhafra base in the UAE and Al Adari in Kuwait.
They even went as far as inscribing messages on the ballistic missiles saying thank you to various nations, just engineering a psychological operation to fracture the international community.
Executing sustained strikes on sovereign allied bases in the Gulf confirms the conflict has bypassed containment. It's a regional war at that point.
Yet the divergence from rhetoric coming out of Washington was staggering. I mean, the cognitive dissonance here is profound.
Oh, completely.
While physical missiles were detonating on oil depots and U.S. bases, the U.S. president was broadcasting a 10-day extension to a military ultimatum. He was claiming ceasefire talks were going well and that Iranian negotiators were literally begging for a deal.
It creates a massive disconnect.
It's like the meteorological service insisting the weather is sunny and calm while you are physically standing inside a Category 5 hurricane.
Yeah.
So, in a scenario where energy inflation is all but guaranteed due to the Yazd strike and Hormuz disruptions, how does this disrupt the safe haven thesis for digital assets in the immediate term?
Well, you have to understand that algorithms and fiduciaries price physical thermodynamic reality over diplomatic abstraction.
Right.
A ballistic strike threatening crude oil transit mathematically guarantees upstream energy inflation. When energy logistics are threatened, central banks have to keep liquidity tight.
To fight the inflation.
Exactly. And in a tight liquidity environment, traditional capital retreats into fiat cash equivalents to cover broader portfolio margin requirements.
So they indiscriminately sell highly liquid assets.
Exactly. Including Bitcoin ETFs. They sell them off simply to shore up their cash reserves during a sovereign panic. The safe haven thesis might be a long-term reality, but short-term. It's treated as a high beta risk proxy.
And this collision of violent price drops and global macroeconomic anxiety creates immediate, tangible friction for corporations and regulators, doesn't it?
Oh, massively.
Like, look at the corporate accounting friction. I'm looking at LM Funding America, LMFA. Despite achieving a 19% year-over-year revenue growth and doubling their digital asset holdings, they were forced to report a massive $17.9 million net loss.
Yeah, that is a direct consequence of the strict GAAP impairment rules. It's a punitive friction point.
But wait, if they never physically sold the asset, that's just a paper loss. Why does the accounting standard force them to report a $17.9 million hit to their net income just because of a temporary microstructural drop?
Because non-cash fair value impairment rules force corporate accumulators to record a loss when the spot price drops to its lowest observable point during the reporting period,
Even if it recovers the next day.
even if it recovers the very next day.
Yeah.
Regardless of whether they sold a single coin, they have to record that dip as a permanent impairment charge against their earnings. It mathematically guarantees their equity valuations degrade during these microstructural drawdowns.
That is wild. It creates such a massive deterrent for executives.
It really does.
But speaking of executives, let's shift to Washington, because we saw a massive signal from the executive branch this week. Crypto-native architects Mark Andreessen and Fred Ursum were officially appointed to the President's Council of Advisors on Science and Technology.
ECAST.
Yeah.
Yeah.
That signals the deepest integration of digital asset proponents into federal policy to date.
It's a structural shift. They now sit at the apex of federal advisory power.
But then you look at the legislative branch, and there's complete paralysis.
Total gridlock.
The highly anticipated markup of the Digital Asset Market Clarity Act by the Senate Banking Committee is just stalled out.
And the core friction there is a closed-door compromise heavily influenced by the Independent Community Bankers of America, the ICBA.
Right. The bank successfully lobbied to explicitly ban digital asset platforms from offering passive yield on stablecoins. So let me get this straight. We have legendary venture capitalists advising the president, but community banks are the ones actually writing the statutory language to protect their own moat.
That's exactly what's happening. The traditional financial system ran the models, and they are terrified of an existential deposit flight.
Unpack the stakes there.
Well, their models show that unconstrained high-yield stablecoins could drain $850 billion from community bank lending capacity.
$850 billion.
Yeah. Why keep your money in a local bank yielding nothing when a stablecoin can instantly route it to a protocol yielding 5%? So by lobbying to ban passive yield, the legacy system temporarily neutered the threat of decentralized finance, acting as a superior synthetic savings account.
And the market reaction was instantaneous, wasn't it? Circle's equity valuation plunged 20%. They raised $5.6 billion in a single session.
The market priced in that regulatory blockade instantly. But you have to balance this by looking at the broader inevitability of tokenization.
Right. The House Financial Services Committee hearing.
Exactly. That hearing officially acknowledged that the real-world asset tokenization market has already scaled to $26.5 billion. It proves that the infrastructure to bypass legacy clearinghouses is being built regardless of this stablecoin yield fight.
So to synthesize all of this for you listening, over a single 24-hour window, the ecosystem absorbed an algorithmic cleansing of $228 million in speculative long leverage.
Right.
It navigated the largest ETF capital flight in weeks due to kinetic energy shocks in the Middle East, and it witnessed the legacy banking system pull the emergency brake on programmable yield.
A crucible of microstructural weakness and macroeconomic stress all at once.
Which leaves us with a final, forward-looking question to mull over. If the legacy banking lobby successfully outlaws passive yield on stablecoins purely to protect their own deposits, won't that just hyper-accelerate the tokenization of other yield-bearing instruments like treasuries and private credit to bypass the banking layer entirely?
That's the real question.
When the $26.5 billion tokenization market realizes it doesn't need traditional permission anymore, does the bank's regulatory victory actually secure their future or just guarantee their obsolescence? Something to think about. Keep questioning the consensus, stay curious, and thank you for joining us on this custom deep dive.